Welcome to the Dealmaking with Laura Difrancesco podcast. I'm Laura Difrancesco, your host. We're talking all about mergers and acquisitions, buying and selling small businesses, as well as corporate law. We are taking our experience closing over $10 billion of transactions since founding Dean Street Law 5 years ago, and my experience being an M&A and corporate attorney for over a decade and making it accessible to you as an entrepreneur. I hope that this helps you in navigating the complex world of mergers and acquisitions. And also, we're always happy to be a resource for you here at Dean Street Law. You can always apply to work with us through our complimentary consultations linked in our show notes. And a huge shout out and thank you to everyone who's subscribed and left us a 5-star review. If you haven't yet, be sure to subscribe and also leave us a 5-star review. It's one of the best ways to support us as a small business. And also be sure to share with your friends and colleagues on social media, through text, email, or however is easiest. It means the world to us that you're supporting our content and helps us make more to support you in your journey. Welcome to another episode of the Dealmaking with Laura Difrancesco podcast. Today we are talking about the differences between entrepreneurship through acquisition and starting a business. So you can think a little bit more about whether it's the right decision for you, weigh the pros and cons, and better understand it. We're doing this to celebrate the launch of my new book, Entrepreneurship Through Acquisition, a legal guide to buying a small business. If you haven't checked it out yet, it would mean the absolute world to me if you check it out through the link in our show notes. You can check out the first chapter, see if it's for you, pre-order, leave us a 5-star review. It is coming out June 30th, and I'm really excited. Everybody who leaves us a 5-star review, we're going to be sharing with you our pre-LOI due diligence request list. So a little insight from Acquisition Insights, which is our course on entrepreneurship through acquisition, where we have our battle-tested templates. We're going to be giving you one of those battle-tested templates, which is our pre-LOI due diligence request list. So this series on entrepreneurship through acquisition is to celebrate the launch of my new book, and we have so much more coming to you. So we just did an episode on what is entrepreneurship through acquisition. Now we're going to be comparing and doing a more robust comparison of starting a business versus acquiring a business. Then we have an episode on the different types of entrepreneurship through acquisition, whether you're self-funded, doing a search fund, independent sponsor model. So going through all the different types and models of entrepreneurship through acquisition. So I'm really excited. Overall, if you love entrepreneurship through acquisition, we have so much more in store for you as here on the podcast. So be sure to subscribe to Dealmaking with Laura Difrancesco. It has so many different good episodes on mergers and acquisitions. And then we also have our course, Acquisition Insights, over 80 modules of video, written materials, guides, checklists, our battle-tested templates. It's all there. So if you want more, you can explore there. And of course, our legal services through Dean Street Law. A little bit about me, if you're new to my world, I'm Laura Difrancesco, founder of Dean Street Law. I've been doing mergers and acquisitions for over a decade with a particular focus in entrepreneurship through acquisition for the last 5 years. And I also have a portfolio of businesses myself. So I take a look at things both from the legal perspective as well as the entrepreneurial perspective as well. With that said, let's get started. Having done hundreds of transactions myself, thousands in my career, the overall comparison of acquiring a business versus having founded 5 businesses of my own, I feel like I'm actually a really good person to be talking about this. So with that said, you know what entrepreneurship through acquisition is, buying a business as a path to entrepreneurship instead of just starting one. But really, what does that mean? So the path to starting a business can be as quick and simple or long and arduous as you desire. I have a whole course, 60 days to launch your business. We don't need to go there, but you can do it in less than 60 days. You can do it in 600 days. When it took me to launch my first business, I was building that idea from when I was in college and law school to all the way from when I quit big law many years later and started my own business. So it is something that you can add to, something that you can start very low cost. It can be an idea that you're really passionate about, an idea that you think is a good one, test it, pivot. Entrepreneurship is all about making a bet, seeing what sticks, doubling down to what's good, letting go of what's not. It's this evolutionary process of experimentation. And building a business is taking an idea from your head and building physical energy around it, whether that be sharing it with people, getting buy-in, hiring employees, going to market, testing your idea, sharing it with others, getting people to buy it. It's a long process, and you have to build every single aspect from the beginning. You can bootstrap it. You can do it very inexpensively, for sure. I think that's one of the best benefits of entrepreneurship. Starting a business is that you can have your startup costs be as little as you'd like, a couple $100s, registering your business online, setting up a website, and then do it all the rest yourself. And it can be a really low barrier to entry. Of course, that's going to depend on industry, the type of business that you start. You could be starting a unicorn where you raise millions of dollars before you even have a product or a sale. That's an option too. There are different versions of entrepreneurships and different paths and stories throughout. Absolutely, undoubtedly. With that said, there's a lot of differences in terms of time, resources, and overall risk that you're going to experience when you're considering starting a business, which will typically take considerably more time to build out to get to the level of a business that you would want to acquire. And it'll take significant amount of resources, sometimes more than the businesses are selling for. And then it will also take more of your life and your time outside of work as well, right? It depends for sure on the business that you're buying and what sort of resources and support it already has and what you plan to do with it. But overall, you can start really lean if you'd like, or you can grow really big quickly and fundraise with starting a business. It's all about experimentation and making mistakes quickly in the least expensive way, both from time and resources, and then doubling down on the things that make sense. But that takes a really long time. So it depends on where you are in your career, on whether that's something that you desire. Now, a lot of people say that there's a significant amount of risk when you start a business. Most businesses fail. I don't disagree with that. I have multiple businesses and they're at varying stages of profitability and growth. With that said, I do think that it's easier to fail small in starting a business than buying a business. But it's going to take time to build momentum and get to where you'd like to be. Whereas overall, when you're acquiring a business, you're buying, for the most part, a business that's more established. Now, there are acquisitions that you can make of a business that's earlier stage, that's more in its venture capital stage of its life cycle, where it's more experimental, doesn't have those steady profit margins. But most of entrepreneurship through acquisition is geared towards the boring business, the profitable business, the one that has 3 to 5 years strong financials, moderate to low growth, but just kind of chugging along successfully. So for the most part, you have less risk per se than starting a business. But I also think that it will be harder to fail small than it will be when starting a business if you are scrappy and are making mistakes in the least expensive way possible. It's guaranteed that you're going to make mistakes. You have to make it your goal to make those mistakes in the least expensive, least costly way, whether it be time, resources, money, so that you're able to continue to pivot and experiment and grow day by day in your journey of entrepreneurship. When it comes to navigating corporate law, entrepreneurship, and managing small businesses, experience matters. Dean Street Law is a boutique corporate firm specializing in mergers and acquisitions and additional focus in real estate, commercial transactions, finance, and corporate governance. With over $10 billion in deals closed, Dean Street Law has extensive experience representing hundreds of clients in thousands of transactions, from small businesses to Fortune 500 companies. Whether you need startup guidance or advice on closing multi-million or multi-billion-dollar deals, we're your trusted partner every step of the way. Visit deanstreetlaw.com in the show notes to schedule a complimentary consultation. So when you are buying a business, you will generally need considerably more capital. In starting a business, you can start lean. You could start with an industry where it has a lot less startup costs. You can certainly do that as well in buying a business, but for the sole reason that you're buying rather than building, it tends to require more upfront capital. With that said, sometimes it would cost way, way more to build that business than to buy that business. But that cost would be over years or decades versus that cost upfront. So you have to think about that and also consider financing options as well of how you can finance that. But at any point, if you were to build a business, you could decide it's not for you. Whereas when you have financing commitments, those are obligations that you make that you need to honor. So most of them are followed by a personal guarantee of some sort. So the risk tolerance is different for sure. I think you can fail smaller in entrepreneurship, whereas when you fail in entrepreneurship through acquisition, it's more expensive and you're more tied and more committed to it than if you started a business and find out $50,000 in that you're making a bad decision and it's not the industry you want to be in. You then have to either sell the business or exit in some way. Of course, time is huge. Time is money. Time is everything. So when you're talking about that, buying a business, you're condensing time. You have your built-in customers, built-in vendors, built-in business structure, operations, whether that be product or service, blend of both. So you have the infrastructure there to maintain a business. And sometimes also, if you're thinking about it from a financial perspective, you also have the income to pay yourself. As an entrepreneur, most entrepreneurs, especially if you're doing the scrappy style startup where you're getting it as lean as possible, you're not paying yourself for a long time. Whereas a lot of businesses that are considered in entrepreneurship through acquisition with that significant financial history, that positive financial history, that does have enough to immediately start paying you a salary. So those are different pros and cons and considerations. I also like to think of barriers to entry as one of the primary reasons that I would buy a business versus start a business. So my businesses that I have today, I would never buy a law firm. I don't believe in how they're run. I think that it would be incredibly difficult to turn the ship of culture in a law firm. That's something that I would only start. And I say that purely because I worked in big law for 7 or 8 years, and it was an incredibly toxic environment, which didn't make sense to the partners, didn't make sense to the associates, didn't make sense to the customers. No one was winning that situation, and the culture was absolutely terrible. It didn't serve anybody. So to me, that's never a business that I would buy. Knock on wood. Maybe I may want to expand one day and I may find the one with the right culture that feels like a fit and makes sense. I'm not saying I never would do that, but my likelihood of buying a law firm versus building one are incredibly different because of culture, something steering the ship. You can't just turn that around very easily, especially if what you're buying is the book of business and the people handling that business. And then if I'm thinking about my business of Airbnbs and how that was built at my farm. So I have a farm with Airbnbs. It's next to my fiance's winery and vineyard. It's wonderful. It's Ethereal Farms if you want to check it out. And Dean Street Law is our law firm as well. Of course, we're happy to help you with your entrepreneurship through acquisition aspirations. So would I have bought that with turnkey Airbnbs? Probably not, because to me, it doesn't justify the profit margins. And to buy something turnkey, you often lose the benefit of the upside. In addition to that is part passion project of having a farm and having animals and building that. But the Airbnb aspect of it specifically, we also built out, and that generates a considerable amount of profit because we did it all ourselves. So that I wanted to build, but I will say that business was specifically built on part our existing winery and vineyard, because we have 200 plus people a day sometimes enjoying the winery, live music, food trucks, all that. So we have built-in marketing channel for the Airbnbs, and it's complementary to an existing business within the portfolio. And we do use that marketing. We market every week to the email list that the winery has, as well as our own marketing. So that was something that made sense to build both from a complementary perspective and a profit perspective. And then when I'm thinking about Flourish co-working and event space in Westchester, that was the second business that I built. So I built Teen Street Law first, and then Flourish was second because we needed office space for our team. We were growing quickly, and I wanted to create a space not just for my team, but for others where they could co-work, host events, have community. Knowing what I know now, I would not buy it because it's a very tricky business. Now, I opened ours January 1st of 2020 and was shut down 3 months later due to economic, geopolitical changes, which is a business risk. So 2020 vision hindsight, I wouldn't buy that business because I still think that there's an incredible amount of risk in that business. And I've only been able to withstand the up and downs of that market because I started the business and because I have other income streams, and essentially it pays for itself by being our office space. So I wouldn't buy that, but it would probably be cheaper for someone else to buy had they not known all the things that I know. And honestly, probably a lot of those things wouldn't happen again. We had COVID, and then we had the crash of the office market. So two things: less than 50% of the local co-working and event spaces in the area are still standing. So we were one of the few to make it through all of those changes. And that's purely because I have diversified my portfolio of businesses, and that works. Now, it would probably be a lot cheaper for most people to buy a co-working space at this point in the market than it would be for them to start one. So that's consideration. I don't know that I would do it because I wouldn't do it again. I would continue building what I have, which is very different than what's out there. But I, at this point, wouldn't make an investment decision for that just because of what I've learned in the risks and the challenges of having that type of business, particularly in the mismatch of the obligations to the landlord, having a long-term lease, but having a short-term product. So you have people who can cancel their memberships in a day notice or less in most cases, and event spaces that can be booked a couple weeks out or canceled. And so you have short-term obligations, whereas you have a long-term lease. Now, the same thing is true in Airbnbs, but at the same time, they're considerably more resilient, at least in the economy so far. Whereas when the market crashed with respect to office space, it likewise crashed with respect to co-working spaces because businesses no longer wanted to pay for office space, and it would actually be more expensive for most of them to use co-working spaces. And so it is kind of in this weird space, and you have this mismatch, which I think was one of the huge reasons why one of the biggest co-working spaces there were, WeWork, was not successful, was because they kept signing up for these super long-term leases, but their vacancies were really high and they had these long obligations, whereas their customers did not. So to me, that's something that I would be looking for in a business. And then I have my educational company that, again, I founded, but is something that I wouldn't have any other way. So I've founded most of my businesses, but when I'm thinking of barriers to entry and businesses that I would acquire a business that it wasn't so easy to start, and a business that I don't want to spend the time building. A lot of people think that they can go to market and just market this brilliant idea that they have. And I can assure you, from someone who markets 5 different businesses, that it is not easy to get attention. So if I was looking to tap into a new market that wasn't complementary to the businesses that I have, I would absolutely buy a business. So if I was looking at consumer products that I wanted to do, I would buy that business. If it was technical, I would buy that business. If I didn't have a business, at this point in my life, I would probably buy a business, because while I was very fortunate to make the change that I did and was immediately successful at this point in my life, getting married in a month and wanting to have a family, it is more important to me and more risky for me to not have an income than it would have been back then. I did save up for years before I started my businesses to make that transition. But at the same time, that could have been used to buy a business instead of having a runway to build a business. And I think it would have served me really well. So barriers to entry in terms of technicality of manufacturing something or having a service-based business or something like that. Overall, I don't know how many more businesses I would start. At this point, I would probably buy a business, just because I think that that would be the logical next step for me based on where I am in my career, my overall resources, my experience in this area. So that's kind of how I think of buying a business versus building a business, and why I did what I did versus what I would do now looking forward. Of course, the journey for each is going to be very different. When you're building something, it's going to be innately yours. You're making a piece of art. You're making a masterpiece with every decision that you make. So for me, building my businesses, I'm infusing them with culture, operational efficiency, standard and procedures, enabling them to run more sufficiently by themselves daily. At the same time, it still is, they haven't all hit the bus test. If you get hit by a bus, would your businesses still survive? At this point, my businesses wouldn't, and we're 5 years in. So when you're thinking of the longevity of your legacy and overall that journey, that also shows you a really stark difference between building a business versus buying a business. And when you think about that bus test, whether it be for you or your family, most of the time you can get there a lot easier through buying a business, because it'll already have that foundation. It won't be that same masterpiece that you've built that just is infused with you and feels like you and feels good from the inside out. But you have the opportunity to take something that's good and make it great. If you haven't read the book by Jim Collins, Good to Great, I really encourage you to do so. It is a phenomenal book. I actually think it would be a great idea if I did some book-ish episodes. So let me know if you'd like that for upcoming episodes of books that I really like on entrepreneurship through acquisition, on overall entrepreneurship. Actually, if you didn't know, I have another podcast called We Grow Together, and we have the Wild Ambition Book Club, where we share entrepreneurship books, personal development books, fiction, romance. All of that is on our Wild Ambition. And then we have specific episodes actually dedicated that will be released soon on my favorite books that I love, especially on entrepreneurship. Lifestyle design are the two focuses of my podcast, We Grow Together. So if you want to check out more about that, you are welcome to. The journey, of course, will be more condensed in buying a business. While it may take a year or two to buy a business, and it's certainly going to take time to ramp up, that's considerably less than building a business. At this point, you could buy a multi-million-dollar business with a couple $100,000 as your investment that you're making, and do that. And then in 2 years have bought a business, growing the business, scaling it, and be really on your way. When you're thinking about that timeline to build a multi-million-dollar business, it can take 5 years, 10 years, just depends on the industry, your success, your investments, whether you're self-funding it or bringing on investors. And then, of course, the financing is going to be drastically different. Your options for starting a business versus building a business. There's a lot of different opportunities for fundraising. When you are buying a business, there's a lot of different opportunities for debt financing as well when you're buying a business, because that has most of the entrepreneurship through acquisition profile is looking at a steady, safe business with 3 to 5 years strong, predictable financials. There is still risk that that asset may not be an appreciating asset. It's not a guarantee, but because there is less risk, there's considerably more financing options. And sometimes that also helps you do your own underwriting, determining whether it's a good investment for you, getting feedback from investors and banks, and finding them as part of your deal team. With respect to starting a business, there are considerably less, in my opinion, financing options. It's much harder to get a loan with a business that you don't have. In addition to that, there are fundraising opportunities, but you're giving up so much more in the business because the risk is higher. So there's a lot more fundraising opportunities in entrepreneurship through acquisition than there is in starting a business. Thinking about buying a business? Unlock the secrets of successful acquisitions with Acquisition Insights, your legal roadmap for success. With over 81 modules of video lectures, written materials, guides, and checklists, we provide in-depth guidance to navigate every step of the process. From initial interest to closing the deal, get the expertise you need to make informed decisions. You can also access our battle-tested templates in the Acquisition Insights course and templates bundle, including our template LOIs, letters of intent, pre- and post-LOI due diligence request list, material deal terms lists, and more. Visit lauradifrancesco.co/the-shop today and take the first step towards buying your dream business. All the links are in the show notes. Let's talk about that upfront risk and uncertainty. How risky is it to buy a business versus build a business? I actually think that they're just different. There's neither of them that is more risky than the other. As I mentioned, you have the risk and the ability to fail small, in my opinion, a lot easier if you're scrappy and you want to do a lean startup in the startup world. If you are failing in entrepreneurship through acquisition, that's a much deeper fall because it's typically a considerably bigger upfront investment. That's not always the case. You could make a giant upfront investment in your business through starting a business as well. It costs $200,000-ish to start and operate Flourish for a year or so, and maybe a little bit more than that. So that to me is very different because I bought it versus leasing Flourish and just building it out and having the employees, whereas for the farm, you're buying a whole asset and then also building out the renovations and employees and everything like that. So you can fail big in starting a business too. I'm not saying that you can't. You can make huge investments there too, but you can also manage them differently. You can buy a smaller business, absolutely, but that's typically going to be a business with smaller resources to run that business. It might be you managing it or you being the only employee or something like that. So there are ways to fail small. There are ways to fail small in entrepreneurship through acquisition, but for the most part, it has a certain level of upfront investment that's required that is considerably more than starting a business. Let's address the elephant in the room that there's been so many people that I've heard saying that they're not going to invest a dime and they're going to only fundraise and they have this board and they're going to buy a business without spending a dollar. I find those blow up all the time, and they are not well regarded from sellers at all. Sellers want to know that there's financial wherewithal to pay them back. They want to know that you're putting in a significant amount of investment at closing and that you have skin in the game so that their seller note means something, so that they know that they're transitioning their legacy to someone who will be successful. So the people that want to buy a business with no money invested themselves, it is possible to do that well, to do that the right way, fundraising the right way. But I see it also blow up in people's faces because they think it's like this thing they're getting away with. And a lot of other people in the space, sellers particularly, don't find that attractive. So most of the time you do have to put in a significant amount of investment. That doesn't mean that it has to be yours. You can still fundraise from other people, but most of the time you're investing something. Legal costs, the costs for your financial due diligence, most of the time you're going to be investing something. There is search funds, which you may invest less. But remember, when you fundraise, you're giving up your control, you're giving up your rights, you're giving up your opportunity for profit. So all of those things are deeply impacted by your amount that you fundraise and what you give up in exchange for that. So how do you evaluate that risk in deciding between entrepreneurship startup versus entrepreneurship through acquisition? To me, it's just preference. What do you feel drawn to? What do you feel most aligns with your lifestyle and where you want to be and your goals in 10 months, 10 years, and 10 days? What are your goals? Who do you want to be? And which do you find serves you better? They're both just tools to paths to entrepreneurship. And then the emotional risks in startups versus acquisitions, I think parallel your financial risks, to be honest. There's ups and downs in entrepreneurships. That's a given. I don't see one being any different than the other, but I don't see one being any bigger than the other, but I do see them being very different in terms of the emotional risks, and the emotional toll of a startup is going to be a lot of failing forward and frustration and just like processing the emotion of that constant change and constant evolution. It's certainly not going to disappear when you acquire a business, but it'll be very different. It's making bigger bets, trying to get the information you need to make informed decisions, and learning on the fly and getting uncomfortable being in something where you didn't build it. And so you've got to learn it. And then question the team wrote here is, where do founders usually stumble early on? So I think the number one thing where founders and where people who acquire a business stumble early on is that hubris of thinking that they know more than they do and not knowing when to reach out for help. One of the biggest things that I see people in the acquisition world mistakes make, and actually we have a top 5 or 6 mistakes made in acquiring a business, is that they think that they know more than they do. And they think that, I see this especially in private equity, people that come from private equity or investment banking or financial backgrounds where they've been doing deal making to some extent or level. They think they know all of the material terms and how to structure a deal. And they think that these templates that they took from somewhere can be used, but they don't know what it says. They don't know what it doesn't say. And they just don't have that enough deal reps to really be able to determine their deal structure on their own and deal terms on their own. And so they have this hubris that they know so much more. And I think that likewise, there's a big mistake in thinking that they know the seller's business better than the seller knows their business. And they come with all these grandiose ideas of how they plan to grow and scale. And it just takes a certain level of humility to accept the fact that you're entering into a world where you know less, and to be humble about that and ask questions and be a curious observer and learn and ingratiate yourself into the business before deciding how you're going to flip it upside down and backwards. And just know that no matter what you do when you're buying a business, the seller will always know more about the business because they've been doing the business for so much longer than you have. So no matter your due diligence, no matter your research into the industry, they're inherently going to know more. And then likewise, I think founders really mistake the same things and the same hubris, and sometimes they make bigger bets than they should because they think that they're so right and they know the market and they know the product and they know all of these things just from a theoretical standpoint. And they miss the need to make educated decisions and then get feedback and pivot. And educated decisions, feedback, and pivot, that evolution, they think that they can skip those steps, and they find quickly through the life lessons that life likes to teach us that there are so many things that you need to know in entrepreneurship and so many things that you need to know in doing business that you can't just assume that you know everything, and you need to know who to turn to. So with that said, if you do need legal support, of course, be sure to reach out to us. us at Dean Street Law. You can schedule a consultation call through the link in our bio, and we would be happy to chat with you. I hope that this episode has been helpful in our Entrepreneurship Through Acquisition series. If you would love to check out my book, it would mean the world to me, Entrepreneurship Through Acquisition, a legal guide to buying a small business. You can check it out through the link in our show notes. You can download the first chapter, pre-order it, leave us a 5-star review so that you can get the pre-LOI due diligence request list. And thank you so much for supporting our podcast. I look forward to seeing you in the next episode. Be sure to subscribe, share it with friends, and let us know what you'd like to see next. Cheers and happy deal making. Thank you so much for joining us on this episode of the Dealmaking with Laura Difrancesco podcast. I hope you found today's discussion insightful and that it brought you one step closer to mastering the art of mergers and acquisitions. If you enjoyed this episode, please be sure to follow and subscribe to Dealmaking with Laura Difrancesco on your favorite podcast platform so you never miss an episode. And if you found value in our discussion, please leave a 5-star review. It would mean the world to us, and share this podcast with your network, friends, and colleagues. For more in-depth resources, be sure to visit our website, deanstreetlaw.com, where you can find articles, guides, and more information on our services. Don't forget to follow us on social media for the latest episodes, updates, tips, and exclusive content. You can find us on LinkedIn, Search Funder, at LMDFrancesco on X, and at Dean Street Law on Instagram. Join us on our next episode where we'll explore more deal-making insights. Cheers and happy deal-making.